Okay, so in this video, I'm going to share a unique approach to trading and investing that I've been exploring. Whether you're just starting out in the stock market or you've been trading for a while, I think you'll find some valuable insights here. Now, I want to be upfront. I'm still learning myself, but I do believe this video contains some really valuable information about trading strategies. And to make sure you understand how this strategy works, it's really important that you check out the requirements at the end of this video. A different approach to investing. When we think about long-term investing, there are some common ideas that come to mind. It often involves picking a company you believe in and holding onto its stock for years. But what if there was a way to take a more active role in growing your investment while still maintaining a long-term focus? That's the idea behind the long-term share growth engine. It's a strategy that I've been developing, and it has a few key elements that set it apart. Strategy centers on a single company, for example, NVIDIA, and it's designed to be implemented over a specific time frame, like 3 to 5 years. Prioritizing share accumulation. Like the primary goal during that 3 to 5 year period is to increase the number of shares held in that company. Selling and buying on downward movements. The main technique used to accumulate shares is to sell them when the price is moving downward and then buy them back at a lower price. These key elements work together to create a different approach to long-term investing, one that's less passive and potentially more rewarding. In the following sections, we'll explore these elements in more detail and see how they can contribute to a long-term share growth engine. One of the key aspects of the long-term share growth engine is its focused long-term perspective. This means two things. Instead of diversifying across many different stocks, this strategy centers on a single company. For example, you might choose to focus solely on NVIDIA. This allows for a deeper understanding of the company's business, its industry, and the factors that drive its stock price. It's about becoming an expert on one specific stock. The strategy is designed to be implemented over a specific period, such as 3 to 5 years. This time frame provides a clear window for achieving your share accumulation goals. It's not an open-ended buy and hold forever approach. This focused long-term perspective offers several advantages. It allows increased knowledge by specializing in one company. You can make more informed trading decisions. You can concentrate your research and analysis efforts rather than spreading them thin across multiple stocks. Clearer goals. Having a defined time frame helps you track your progress and stay motivated. In traditional long-term investing, the primary focus is often on the stock's price. Investors track the dollar value of their investment and aim for capital appreciation. The goal is for the price to go up, so the overall value of their holdings increases. The long-term share growth engine shifts this focus. While price is still important, the primary objective is to increase the number of shares held in the chosen company. This means that instead of solely worrying about the stock's price fluctuations, the strategy aims to capitalize on those fluctuations to accumulate more shares. Why prioritize share accumulation? Because in the long run, a larger share base provides greater potential for growth. Even if the stock price experiences periods of decline, a growing number of shares will amplify the gains when the price eventually rises. It's about building a solid foundation of ownership that can generate significant returns over time. In the next section, we'll delve into the core strategy used to achieve this share accumulation, selling and buying on downward movements. The long-term share growth engine employs a specific trading technique to achieve share accumulation. This technique focuses on capitalizing on significant price declines, also known as dips. This is a key distinction from strategies that might attempt to trade every small fluctuation in price. Here's how it works. Shares are sold when the stock price experiences a dramatic decline or dip. This is often triggered by a predetermined stop-loss point or a clear indication of strong downward momentum. The focus is on selling during periods of substantial price weakness. For example, imagine you own 100 shares of NVIDIA. The price is $100 per share. If the price suddenly drops to $97, but you had previously set your stop loss at $98.50, the price dip triggers your stop loss. Your 100 shares are sold at $98.50. The goal is to repurchase those shares or more at an even lower price after the dip. By selling during significant declines and buying back at a lower price, the strategy aims to increase the total number of shares held. Continuing the NVIDIA example, you might buy back shares when the price reaches $98.17. In this scenario, you sold your 100 shares at $98.50. You were able to buy them back at $98.17. This resulted in an increase of approximately 0.33%. So instead of having 100 shares, you now have 100.33 shares. While this may seem like a small gain in a single trade, the cumulative effect over time can be significant. If you can consistently achieve an average gain in shares, for example, 0.33% over a longer period, the compounding effect can lead to a substantial increase in your holdings. It's important to note that achieving a consistent daily gain is difficult, as the market is inherently unpredictable. Therefore, it's more practical to focus on a longer time frame, such as a monthly average, to evaluate the effectiveness of the strategy. This core strategy is what drives the share accumulation in the long-term share growth engine. It's a more active approach to managing a long-term investment, specifically seeking to leverage significant market downturns to increase share count. In the following sections, we'll explore the importance of managing risk and the disciplines required to implement this strategy effectively. So one of the things I've been really focused on with this strategy is how to deal with different market conditions, because the market's not always going to do the same thing. It changes all the time. And I've identified 3 main trends, and here's how I try to approach them. Okay, so an uptrend is when the stock price is generally moving higher, it's going up, and you can try to make gains during an uptrend. But here's the thing I've realized: it can be really risky. You can easily end up losing shares if you're not careful. So if I see the stock price just going straight up, I've found that the best approach for me is to just not sell, just let it ride, wait for the market to stabilize a bit. Because in this scenario, it's really not sell-fi. Then you have what I call a linear or choppy market. This is when the price is kind of bouncing around, going up and down, but not really going anywhere in particular. It's not a clear uptrend or downtrend. And these periods can be tricky. It's hard to predict what's going to happen next. So during these times, I've learned that it's best to be cautious, Now a dip or a downtrend, that's where this strategy really shines. That's when you see a significant price decline, a substantial drop, and that's when I focus on using the core mechanic of the strategy. That's when I sell shares, and then I try to buy them back at an even lower price to accumulate more shares. This scenario is definitely best for strategy. So by recognizing these different market trends and then adapting my approach, I can hopefully make the long-term share growth engine work more effectively. Okay, so we've talked about the core idea and how it works with market trends, but to really make this long-term share growth engine work, there are certain disciplines you need to follow. It's not just about selling and buying. There's more to it than that. Here are some key disciplines that I've found to be really important, and this is how I approach them. Rigorous stock selection. First off, it starts with choosing the right stock. You can't just pick any company. You need to do your homework. You need to select a company that is fundamentally sound and that doesn't have wild price swings. You want a company that you can really understand. Disciplined trading. Having a trading plan is the discipline. Emotional control, this is a big one. It's easy to get emotional, especially if you set a stop loss in a dip, but suddenly the price goes up and you end up losing a percentage of your shares. You have to be able to control your emotions. So you have to keep in mind that this is a long-term strategy. And there will be bad days. Don't let fear or greed drive your decisions. Stay calm and stick to your plan. It's continual learning. The stock price is always changing. The benefits of this long-term strategy are that you get to know the company better, giving an extra confidence in predicting the market a little better compared to monitoring multiple stocks. By selecting only one company and focusing on that company, you get more practice and it's easier to track. You can check the news, the trends of the market, etc. Record keeping, it's really important to keep good records of all your trades. I personally use Google Sheets to track everything I do by the end of the day. You should track your gains and losses. Patience, this strategy is about long-term growth. Like, it's not a get-rich-quick scheme. You have to be patient and let the process work. Focus, and finally, you have to stay focused on your goal, which is accumulating shares. Don't get too distracted by the short-term ups and downs of the stock price. Remember that we focus on shares and not the price of the shares. Don't get discouraged. Don't get discouraged if your goal is 0.33% per day. Even a 0.15% gain is good. To effectively implement the long-term share growth engine, it's essential to track your progress and envision the potential for long-term growth. I personally use Google Sheets to meticulously record my daily trading activity. This allows me to monitor my share accumulation, analyze my performance, and make informed decisions. As you can see from the screenshot of my Google Sheet, I track several key metrics. Date and log. I record the date of each trading day and any relevant notes. Percentage gains. I calculate the percentage gain or loss in shares for each trade. Current shares, I keep a running total of my share count. Monthly average, I calculate a monthly average of my daily percentage gains. This helps me assess my overall performance and stay on track with my goals. 5-year projections. I've created a section to project my potential share growth and portfolio value over a 5-year period. These projections are based on my daily average gains and can be adjusted to reflect different scenarios. It's important to remember that these projections are based on assumptions, and that actual results may vary. However, they provide a valuable tool for envisioning the potential of the long-term share growth engine. Here are some key insights regarding results and projections. Focus on share growth. It's crucial to focus on the growth of your share count, not just the share price. As your share count increases, the impact of each percentage gain also increases. For example, a 0.33% gain on 100 shares is significantly different from a 0.33% gain on 550 shares. Accurate record keeping. I've modified my Google Sheets record keeping system multiple times to be as accurate as possible, always adjusting and polishing as needed. Trading day analysis in my spreadsheet. It's important to analyze trading days. I don't include weekends in my tracking as the market is closed and my share count remains the same. My strategy is based only on trading days. Okay, so we've covered a lot here. The long-term share growth engine, how it works, all that stuff. And as we wrap things up, I want to leave you with the most important things to remember. These are the key requirements and considerations that, in my opinion, are absolutely crucial for you to think about. First, let's talk about day trading regulations. Remember, because this strategy does involve active trading, it can fall under day trading rules. These rules, set by the U.S. Securities and Exchange Commission, or SEC, generally require you to have at least $25,000 in a margin account. So to give yourself a bit of a buffer and avoid any potential issues, I really recommend having at least $40,000 in your portfolio. You could consider a bit less, like $35,000, but honestly, you've got to be super aware of the SEC's day trading requirements. That's really important. Next, trading platform and costs. The trading platform you use makes a huge difference with this strategy. If you have to pay a commission every single time you trade, that can seriously eat into your profits. No question about it. I personally use a commission-free platform like Robinhood. So if your broker does charge trading fees, this strategy might not be the best fit for you. The fact that we now have commission-free trading platforms is a big reason why this strategy is even doable in the first place. Then there's platform proficiency. It's incredibly important to really understand how your trading platform functions. Every platform has its own set of rules, its own limits, its own features. For example, some platforms might have limitations on the types of orders you can place or on when you're allowed to trade. From my own experience with Robinhood, stop-loss orders don't work after the market closes, and sometimes you might not even be able to trade at all after hours. So you got to learn absolutely everything you can about your specific platform. Take the time to do that. Trading education is also absolutely crucial. You've got to have a good, solid understanding of trading concepts and strategies. I spent a lot of time studying the stock market before I even started trading. And I've learned that you always need to keep learning and adapting as you go. Research is helpful, of course, but you also have to get real world experience and just remember Any trading strategy, including this one, is just a plan. It's just a goal. It takes a lot of discipline, and there are always risks involved. So keep that in mind. Independent analysis is another key thing. You've got to be able to think for yourself and analyze information very carefully. You can learn a lot from resources like online videos, but you really shouldn't just blindly believe everything you hear. I think it's a good idea to learn from a variety of different sources, but you should always make your own decisions based on your own analysis and your own judgment. That's the most important. And finally, strategy purpose. Sharing this information with you to give you a different way of looking at trading, especially if you're interested in trading for the long term. The main idea here is share accumulation, which I really haven't seen talked about very much in typical trading discussions. A lot of strategies tend to focus on long-term holding or on the value of your portfolio, but this strategy really focuses on increasing the number of shares that you own. So it's a different approach, and I truly think it's something worth considering if you're looking for a different way to approach the market. With those important points in mind, let's just recap the main elements of the long-term share growth engine one last time. Focused long-term perspective. This strategy focuses on a single company like NVIDIA, and it's designed to be used over a specific period, such as 3 to 5 years. Prioritizing share accumulation. The main goal during that period is to increase the number of shares you own in that company. Core strategy. The main way to accumulate shares is to sell them when the price drops a lot and then buy them back at a lower price.